Hello, my friends. It's Robert Miner with Dynamic Traders Group with a brief video for our YouTube and Twitter followers. If you want to take a look at the video from 3 weeks ago, it was on Bitcoin, gold, and the stock indexes. All three have behaved pretty much as the outlook was for that period of time. As you know, if you've seen these videos before, I'm really just interested not in forecasting the market, but I'm interested in trading opportunities. That's what we're all about. So we want to identify the position of the market, the probable outcome, and I'm usually looking at weekly trends. So not day trading or real short-term trading, but trends that usually last at least 2 to 3 weeks, if not more. So we're going to update the stock indexes in this video today. They've unfolded pretty much as anticipated 3 weeks ago. So let's get started. By the way, if you like what you learn here, check us out at dynamictraders.com. We update all these markets 3 times a week in our DT reports. Okay, let's get started with the S&P. So this is the ES December contract weekly data, the weekly closes, and it's the same chart I showed 3 weeks ago, coming up from this October 2023 low. Here's where my cursor is where we were about 3 weeks ago, and in that video, I identified that more than likely a weekly high was near, and that would be a wave 3 of a wave 5, probably sideways to down for 2 to 3 weeks, and then a new high to finish off what was possible, we call an ending diagonal or fifth wave diagonal. And so what happened? Well, it was sideways to down for almost 2 more weeks, and then went to a new high. And then what's critical right now is what occurred in the last week. In the last week, the ES came down and made a close below this closing high. We call that a closing overlap, and it's a strong signal that in this case, this weekly high is complete, and the market is likely to be sideways to down for several weeks. So good trade opportunity with well-defined capital exposure on the downside for either short the ES or the SPY or bear mutual funds, either unleveraged or with a little bit of leverage. So we're looking at pattern-wise as it's probably complete on that high a week ago or so. And again, this is weekly closing data. And then go down the bottom here is that the weekly momentums have made a dual look-back bear reversal from the overbought zone. Pretty strong signal that a weekly high is complete also. And if that's the case, here's what I'd be looking at. So I have a question mark at it because I always have question marks until something's proven out. And this would only be proven out if there's a close below this, what I got labeled as a wave 4 or 5 low. So it's just the last swing low. It would break the bullish pattern. So that's a ways to go in the market, but we have several strong indications that this is the case, that the weekly high is complete. So if it is, and it gets proven out, I suspect then the S&P should be sideways to down at least for about 5 weeks and potentially into January, and would typically reach at least this, what I got labeled as a wave 4 swing low based on weekly closing data. That's around 54.25. So I don't know if it's going to reach that. It's not a forecast that it's going to reach that, but those would be the typical minimum time and price targets if indeed we've completed this impulsive trend off the October low. Now, I don't expect that this is going to be any major bull market top. It should not be a top that results in a 20% or greater decline. That would be very unusual for that to happen in November, but a normal type of correction of, let's say, 10 to 15%. No big deal. Over a few weeks' time, maybe into the first of next year, maybe a couple months. But the point would be is that we're just in the initial stages of at least a weekly top or probable weekly top. Let's take a look at the daily data. Here's our daily data coming up from the August low, which on the weekly chart was shown as a wave 4 low. So again, we've gone up 1, ABC correction, 2, gone up 3, another high, ABC correction. And again, right where my cursor is where we were 3 weeks ago, anticipating another couple weeks or so net bear trend, and that being, fairly short term, but also being a correction within the weekly bull trend. And that's exactly what happened, an ABC correction, and then this really spike to new highs post-election time. But very little follow through, however. So this was a news event at a new high. It continued for 2 or 3 days here, but didn't continue with any significant follow through. Now, what's happened in this past week is what's significant, is that we already saw that the weekly momentums and that cycle had made bear reversals. We can look down here at the daily momentums. They were dual look back overbought in a position from where highs are typically made, like back in here and around in here. So we had daily and weekly dual time frame momentum position to complete the higher time frame weekly top. And then on Friday, we had the significant down day, and we had a daily close into the closing range of this October high. And so again, closing overlap has probably completed the sequence and the impulsive pattern, not just from the August low, but going back to the October low of 2023. So fairly significant. What this allows us to do is that we're probably in the early days of a weekly trend that would be sideways to down for, again, probably at least about 5 weeks, if not longer. So we could have well-defined stop on any short or bear trade of a close above this closing high on November 11th, and then it's in an immediate position to consider short or bear positions. Before we finish up here, this is the ES, and it's the 240-minute data, and this is how you can use some simple pattern analysis when you get near a reversal point to help you identify maybe early on if that reversal is being made. So this is Wednesday, and I had in our Wednesday DT report update, I showed this 240-minute data. It's coming off the November 4th low, and that was the wave 5 of 5, potentially at least. And that where my cursor is late afternoon of that day when I captured this chart. And I basically had in there is that the market may continue to make a new high. If it did, the high would probably be very minimal on the upside before the whole pattern was complete. But if the S&P should close below, I think this was Tuesday's low, it would indicate that this was a completed little minor ABC correction, and the trend was now bearish, and a new high was not probable. So I just drew a horizontal line across that low, and I have it red on here because red means a bearish if it's crossed, and put an alert for that price. And if the market traded below that low, then more than likely this top was indeed the weekly top. So it was a little early warning before this big down day on Friday, that before Friday's trading even began, that more than likely the trend was down and bearish, and not just for the day, more than likely for a few weeks. So that's what I'm looking at here. Could be wrong. Market may bounce right back to a new high. That's why we have stops. And that's why we pay attention to our position size and multiple unit trading, both keys to longer term success if you want to be a trader. Okay. Well, this is the Nasdaq, the December contract, the daily data, and just a quick look. It's in substantially the same position as the ES, but it's a little bit relatively weaker, and that's unusual because for most of the year, and then actually the last few years, the Nasdaq has usually been relatively stronger. But here the Nasdaq just barely made a new high above the July high, and then turned right around, and like the S&P, had a strong down day on Friday and closed well into the range of this last swing high. And so the Nasdaq is in the same momentum cycle position as the S&P. The weekly momentums are a dual look back bearish from the overbought zone. The daily momentums are bearish, indicates another couple of days sideways to down. One of the trade strategies that I use is sometimes instead of taking the initial reversal signal, is I wait for the market to prove itself that the bear trend is going to continue. And I do that, one of the ways is I look at the momentum cycle, and when it makes the next full cycle and then bear reversal, that usually completes the initial short-term correction against the new weekly bear trend. W.D. Gann said the safest time to enter a market is on the initial reaction to a new trend, and that's basically a takeoff from that advice, and it's a great trade strategy. So if you want to have a little safer entry, we call it a little bit safer, a little more probable that the trend's going to continue lower, is you can wait for an initial reaction or a minor correction against the trend. Now, that doesn't always mean you're going to get one that's obvious. Doesn't always mean you're going to get an entry with a smaller capital exposure. But if your momentum indicator is fairly reliable, you have it do another full cycle, in this case a bear reversal. It's probably 5 or 6 days away, if not a little bit more, because we have to finish this decline, and then it'd be a 3 or 4 day correction, more than likely at least. And that would be another opportunity to get short or in a bear ETF. Well, that's it for today, my friends. If you want to be updated 3 times a week on not only the stock indexes, but all the major markets, go to dynamictraders.com. Check out our DT reports. Get some more information there. You can also sign up with our Traders News. It's absolutely free. No credit card needed, just your email address, so we can let you know when we put up new trade strategies and trade opportunities for free for our Traders News subscribers. Okay, take care. Robert Miner, over and out for now.